If you spend any time looking for financial advice online, you are probably exhausted. Day trading crypto, flipping options contracts, and trying to time market dips is a stressful, high-anxiety approach to money. But the wealthiest investors ignore all of that. They use a highly systematic, boring strategy that takes exactly 5 minutes a month to manage. This chart visualizes data from the SPIVA scorecard, a recurring report tracking the performance of professional money managers. Look at the numbers over a 15-year horizon. 92 to 96% of these highly paid Wall Street professionals fail to beat their benchmark index. You outsmart these professionals by simply owning the entire market through an index fund. An index fund is a passive investment vehicle designed to mathematically track the performance of a specific market benchmark. By owning the whole market, you bypass the mathematically improbable task of picking individual winning stocks. So, grab your laptop and your bank routing number. We are going to build this automated wealth machine right now, step by step. Systematically opting out of the active trading game is the absolute most reliable path to lifelong financial independence. Step 1 is to establish your base of operations. To do this, you need to open a standard brokerage account to hold your investments. Choose from the big 3 providers: Vanguard, Fidelity, or Charles Schwab. For our strategy, these 3 platforms are identical because they have all permanently dropped their stock and ETF trading fees to 0. With your account open, you need to calculate your asset allocation using the 110 rule. Asset allocation is simply the process of dividing your investment portfolio among different categories, like stocks and bonds. This graphic shows the math in action. Subtract your current age from 110. The resulting number is the exact percentage of your portfolio that must be allocated to high-growth stocks, with the remainder kept in safe bonds. If you are 30, that leaves you with roughly 54% in U.S. stocks, 36% in international stocks, and 10% in bonds. You might be tempted to put 100% of your money into the S&P 500. The S&P 500 is a stock market index tracking the 500 largest publicly traded companies in the United States. But doing so exposes you to massive concentration risk because just 10 tech companies make up roughly 30% of that entire index. We include bonds for young investors because they act as portfolio shock absorbers. During a severe market crash, stable bonds reduce your overall losses, which prevents you from panic selling. Asset allocation acts as a psychological fortress, shielding your wealth from emotional impulses during a market crisis. To fill our asset allocation, we follow Vanguard founder Jack Bogle. Don't look for the needle in the haystack, just buy the haystack. This cheat sheet graphic maps out your first purchase, the total U.S. stock market. Using the ticker symbol VTI, you instantly capture roughly 3,700 American companies. VTI is an exchange-traded fund, a basket of securities that trades on an exchange precisely like a regular stock. Next is the total international stock market. Using a ticker like VXUS, you capture over 8,000 global companies spread across developed and emerging markets. The third and final component is the total bond market. A ticker like BND holds roughly 10,000 stable investment-grade U.S. bonds. Logging to your brokerage account, type these exact ticker symbols into the search bar and execute your purchases according to the percentages you calculated with the 110 rule. Look at the sheer scale of what you just bought. Through 3 simple funds, you hold instant ownership stakes in over 20,000 unique assets globally. This extreme diversification guarantees that a single company's failure, bankruptcy, or scandal can never destroy your financial future. The engine that runs this entire lazy portfolio is called dollar cost averaging, or DCA. DCA is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of what the stock market is doing. This line graph talks a fluctuating asset price to demonstrate how DCA works. By setting up a fixed, automatic monthly transfer on payday, the system automatically buys more shares when the market is cheap and fewer shares when the market is expensive. Let's jump into the brokerage interface and set this up, using Charles Schwab as our specific example. Navigate to the Automatic Investments section. From there, link your external checking account using direct deposit or a built-in service like MoneyLink. MoneyLink is simply Schwab's electronic funds transfer tool that pulls cash directly from your external bank. Input your 3 chosen fund symbols, set the exact cash contribution amounts based on your ratios, and select a recurring frequency, like the first of every month. This automation removes human emotion, hesitation, and laziness from the act of wealth building. Setting an automated system guarantees consistency. Mathematically, consistency is the single greatest predictor of compounding wealth over a lifetime. By hitting submit on that automation screen, you have successfully built a world-class portfolio. Your portfolio now runs itself. You literally never have to check the daily financial news or react to a market headline again. There is only one piece of required maintenance: an annual portfolio review using the 5% rule for rebalancing. Rebalancing is the process of realigning the weightings of a portfolio of assets to match your original target percentages. Once a year, check your account. If any fund has drifted more than 5% away from its target allocation, for example, if your U.S. stocks have swelled from 54% up to 65%, you apply the rule. To fix this, do not sell your winners, because selling triggers capital gains taxes. Instead, simply redirect your new automated cash contributions to purchase the specific funds that are currently underweight until the scales balance out. True wealth is built by letting algorithms do the heavy lifting, while you go enjoy your life, completely detached from the daily anxiety of the stock market.